Hi, my name is Catherine Wambui, and my student ID number is 502 35 637. And my research paper was based on earnings management and financial reporting. I wanted to see whether earnings management affects the quality of financial statements, of which it does. And so I went ahead and defined earnings management as when managers manipulate earnings, or they use their judgment of financial reporting to mislead some stakeholders. So to mislead or to influence some stakeholders. So when it comes to misleading, these will be investors who are looking to invest in the companies. So when, say, a company is preparing to launch an IPO, so you'll have financial reports, audited financial reports evaluated by the SEC, by various groups of people, analyzed, and so that's how the stock price is decided upon. And investors looking to invest in such a company, they will be looking at the performance of this company. And so when a company is preparing to launch its IPO, it would want people to invest in that company. And so managers might be incentivized to manipulate earnings to be able to achieve such a goal. Another motivation will be, say, they want to get a loan. So again, lenders will use financial reports to evaluate whether the performance of that company over several years, and see whether this is a viable, it will be a viable investment, or whether they want to extend credit, whether this company can be able to meet its obligations, such as interest payments and so forth. So these are some of the motivations or incentives that can cause managers to manipulate earnings to be able to mislead these groups of people. So again, I went ahead, so I discussed the motivations, of which again I've quoted a few, which is capital markets and valuation, lending contracts, and also compensation contracts, especially when compensation is based on performance, or bonus pegged on the performance of the company's stocks. So managers would want to make sure they get their bonus, or if they're paid using stocks, they may want to manipulate earnings to be able to achieve their compensation. So some companies pay the executive using stock options. So that is a short-term, managers might want to manipulate earnings so that they'll be able to get paid, or to be able to sell their stock options in the short term and take that money out. So I also went ahead and discussed the techniques that are used to manage earnings, and for the most part is accruals. And in accruals, we have techniques like big bad charges, and these will be like restructuring charges, which are or write downs that are just recorded in one period, and so they will not affect earnings going into the future. So the earnings in the current period will be reduced, but going into the future, when maybe the performance is not that great, it is not going to get affected as when this restructuring charge would have been, say, amortized over a long period of time. Another technique that comes with accruals will be cookie jar reserves, and this is when companies set aside some reserves, and they'll call it some accrual for accrual for something, but it's a reserve, and they use these reserves for a rainy days. That's when the companies is not performing as good, and to be able to deepen into that reserve and boost revenues and boost earnings. So that's a quick year reserves. On revenue side, revenue recognition will be things like recognizing revenues too early or delaying revenues. So companies could arrange with their buyers to, at the end of the year, to just accept maybe a shipment, but then they don't, so they record it as a sale on their books, but it's not actually a sale. The buyer has not committed, and some companies, in my research paper, I used a company called Sunbeam Corporation. In the 90s, used this technique whereby it would ship the products to their wholesale buyers, and actually would pay shipment fees and storage fees, and then come at the end of that financial period, it would get back the shipment. So it was not actually a sale. So those are just some of the ways. Also, I looked at the key players in financial reporting, and that is the managers, of course, and that is the CEO, the CFO. Of course, now with SOX, the CFO and the CEO have to certify that the information on the financial statements is correct and is truthful. And also looked, another player will be auditors and auditing committee. Of course, auditing committee will be more of the monitoring role to the executives to make sure they are observing the various rules when it comes to reporting, and the financials are truly reflect the economic condition of the company. So I also looked at some of the ways that can reduce or eliminate earnings management altogether. And some of the things that I looked at was maybe not the tone at the top. If it's ethical, again, that can reduce earnings management. Also, not having managers, being pushed to perform no matter what. Also, and also not basing bonuses on performance of the company. So that would be ways to reduce, or my recommendation on eliminating earnings management. But the big one, of course, is the tone at the top. If it's ethical, it will trickle down to the rest of the company. So earnings quality, for the most part, is reflected through cash flow. So if you're saying that the company had growth in sales or growth in revenues and is not backed by cash flows, we cannot see those amounts when it comes to the cash account, or it's not in the account receivables. Again, those revenues are not real, and that is the earnings quality. So earnings management causes a whole lot of factors that companies fail. Investors cannot trust financial reports anymore because they're so aggressively managed. So that takes a lot of trust and confidence in the accounting process. So those are some of the things that I looked in my paper and answered. Does earnings management affect earnings quality? And yes, it does. Thank you for listening.